Today is January 8th, 2026. Nvidia's stock is hovering around $185 per share. This is a noticeable pullback from its recent all-time high. Just a few months ago, in October 2025, the stock touched an incredible $207.03. Now that the price has cooled off from that peak, investors are facing a monumental question. Here we have a company with a market capitalization that has soared past the $3 trillion mark. Is Nvidia still the unstoppable growth stock that defined the AI boom, or has it become a dangerous value trap, a giant balloon waiting for a pin? The timing of this question could not be more critical. The company is on the verge of launching two of its most anticipated chip architectures, Blackwell Ultra Rubin platforms, which could either propel it to new heights or fall short of sky-high expectations. This isn't just a simple buy or sell decision. It involves understanding a company that has fundamentally reshaped the technology landscape in a very short amount of time. The numbers are staggering. Let us begin with the most jaw-dropping number of all: revenue growth. To put it simply, let's look back just a couple of years. In fiscal year 2023, Nvidia reported total revenue of $26.9 billion. Fast forward to the end of 2025, and the trailing 12 months revenue is about $187 billion. This is not a typo. Sales grew nearly 7 times in about 2 years. This is not a gentle slope, it is a vertical line. It positioned its products as essential tools for the biggest technological shift, the artificial intelligence revolution. The sheer magnitude captured the market's attention and fueled the stock's meteoric rise to a multi-trillion-dollar valuation. This expansion was driven by insatiable demand for data center GPUs. Companies big and small scrambled to build new AI models to train new AI models, and Nvidia's hardware became the default choice. That created a demand shock, letting Nvidia sell massive volumes of chips and command very high prices. The focus shifted from PC graphics for gaming to the far more lucrative data center market. A high-end data center GPU can sell for tens of thousands of dollars. As the mix tilted to high-margin products, the average selling price soared. This explosive growth is the foundation of the bull case. The question now, can this rocket ship keep its trajectory? Can a company this large keep growing at blistering pace? The answer decides whether the stock continues to climb or comes back down to earth. So, why did Nvidia's revenue launch into the stratosphere? The answer can be summed up in 2 letters: AI. The rise of generative artificial intelligence, like the large language models that can write text or create images, created a modern-day gold rush. In this gold rush, Nvidia was not selling the gold itself, but the shovels, pickaxes, heavy machinery needed to mine it, its high-performance GPUs. This created a sudden, massive, and global demand for its products, a demand that no one, perhaps not even Nvidia, had fully anticipated. The biggest buyers in this gold rush were the hyperscalers. They needed to build out vast fleets of AI servers to offer AI services and power their own research. The company's Hopper architecture GPUs, like the H100, became the industry standard. Nvidia sold every chip it could make, and at very profitable prices. It wasn't just selling more chips, it was selling much more expensive chips. The multiplier effect created exponential revenue growth. Furthermore, Nvidia built a powerful ecosystem around its hardware. Its CUDA software platform made it easier for developers to build AI applications on its GPUs. This created a deep and sticky moat. Once a company invests in CUDA, switching becomes difficult and expensive, granting pricing power and indispensability. This combination of the right hardware for the right trend at the right time, with a strong software moat, explains the unprecedented sales boom. One of the most remarkable parts of Nvidia's story is its profit margins. Typically, hardware companies face raw materials, manufacturing, supply chains, keeping margins modest. In late 2025, the company is reporting gross margins consistently in the 70 to 75% range. For every dollar of product it sells, it keeps about 75 cents after direct costs. Software-like numbers, not typical hardware. The first reason is immense pricing power, demand far outstripping supply and limited high-end competition. The company could name its price. Second, the powerful CUDA ecosystem adds tremendous value to each chip, justifying premium pricing, with near zero marginal cost to replicate software. Finally, semiconductor economics. Huge upfront R&D, but relatively low marginal manufacturing cost. High per-unit profitability at scale. This operating leverage, combined with extreme pricing power and a software moat, is the secret sauce behind Nvidia's anomalous software-like margins. Now we get to the tricky subject of valuation. At its current price of around $185 per share, Nvidia trades at a price-to-earnings ratio of about 48.6. The P/E ratio tells you how much investors pay for each dollar of current profits. 48.6 is not cheap by traditional standards. 15 to 20 is typical for slower growers. To understand today's valuation, we have to look at where it has been. Back in 2023, Nvidia's P/E ratio peaked at an eye-watering 147. At that time, price rose before earnings. Today, earnings have grown even faster, bringing P/E down from 147 to about 48.6. This brings us to the forward P/E. Standard P/E looks backward, forward P/E uses estimates for the next 12 months. For a company growing this fast, it's more relevant. If earnings double, 48.6 becomes just over 24 forward. That's why many bulls argue the stock is cheaper than it appears. Is it cheap or expensive? It depends on your belief in future growth. On-screen badge, Rule of 40, growth, plus profit margin, 40%. Nvidia doesn't just pass the Rule of 40, it shatters it. Rare for any company, let alone a hardware maker with software-like margins. If earnings stay phenomenal, 48.6 might be reasonable. If growth slows, the same multiple is risky. The valuation is a tightrope walk. So far, earnings have outrun the high valuation. The multi-trillion-dollar question, how long can it keep up that pace? Beyond the exciting growth and margin numbers, it is crucial to look at a company's financial health. In Nvidia's case, the balance sheet can be described in one simple phrase. It is a fortress. The company is sitting on a massive pile of cash and has very little debt. Over $11 billion in cash and short-term investments, and debt to equity around 0.09. This war chest lets Nvidia heavily fund R&D without borrowing, fueling next-gen chips like the upcoming Blackwell Ultra and Rubin platform. It also provides a safety net to weather shocks without desperate moves. In a rising rate environment, little to no debt is a massive advantage. Others pay interest. Nvidia avoids that burden. Huge cash plus minimal debt equals one of tech's strongest balance sheets. It's a financial moat. Fund acquisitions, invest in new technologies, return capital via buybacks. For investors, this fortress balance sheet lowers risk even at a high valuation. Now we must turn our attention to the potential risks. No company story is perfect. The first one that stands out in Nvidia's recent reports is its inventory level. A key metric is inventory days. For Nvidia, this number has been climbing. It now stands at approximately 103 days. This is a noticeable increase from periods when chips were essentially sold before they were made. Why is rising inventory a red flag? It could mean supply is catching up or exceeding demand. If products sit longer, it hints at a slowdown. However, the rise could be strategic, preparing for massive launches like Blackwell Ultra and Rubin. Building inventory ahead of a launch is common. The truth is likely in between, making it a conundrum and a risk itself until data resolves. Investors will watch the next few quarterly reports closely. If revenue grows strongly and new products sell well, inventory draws down and concern fades. But if growth falters and inventory climbs, it's a major warning that the boom might be fading. The second major red flag for Nvidia is its customer concentration. Having the world's biggest tech companies as main customers sounds great, but it's a significant risk. A very large portion of data center revenue comes from a handful of hyperscale companies. Nvidia's fortunes are deeply tied to their CapEx. A spending pause, even one quarter, hits revenue and profits immediately. These same customers are also potential competitors, developing custom silicon for select workloads. While they haven't displaced Nvidia, it's a long-term threat. As internal chips improve, reliance on Nvidia could lessen for certain tasks, reducing purchases. This dynamic can erode pricing power, either through custom silicon or by playing Nvidia against competitors like AMD. For now, performance leadership keeps Nvidia in the driver's seat, but heavy reliance on a few powerful customers is a key vulnerability in the model. The bull case for Nvidia, the argument for why the stock will continue to go up, is powerful and straightforward. It rests on the belief that the AI revolution is still in its early innings, and that Nvidia will maintain dominance as the key enabler. Relentless innovation and a rapid 1 to 2 year cadence make it hard for competitors to catch up. Consider a scenario where revenue grows 65% year over year into late 2026. With high margins, earnings can grow similarly or faster. If the market rewards elite growth and profitability with a forward PE of 40 to 50, a late 2026 price target of 260 to 380 per share becomes plausible. Bulls see Nvidia as a platform, the operating system for AI, expanding into software, networking, and enterprise services. On the other side, the bear case warns the stock has flown too close to the sun and is due for a significant correction. The unprecedented growth may not be sustainable at this scale. Build-outs mature, growth normalizes lower. If growth slows to 30%, inventories rise, and competition forces price cuts, gross margins could slide towards 60%. If forward PAE compresses to 25 to 30, shares could fall sharply, making 120 to 160 plausible by late 2026. Bears argue there's no room for error. Any delay, miss, or demand weakness could trigger a major sell-off. Maximum hype and maximum risk. So, after looking at all the pieces, where do we land? Is Nvidia at over $3 trillion a historic growth engine or a classic value trap? The evidence suggests it is not a clear-cut value trap, at least not yet. The company's underlying performance is simply too strong. The combination of explosive revenue growth, software-like margins, and a fortress balance sheet, plus consistent execution, justifies much of the hype. The P/E ratio, while high, is far more reasonable than its 2023 peak because earnings have grown so prodigiously. However, calling it a safe bet would be a mistake. Risks are real and growing. Rising inventory days and dependency on a few hyperscalers. A middle ground where growth slows from superhuman to excellent could mean sideways trading that frustrates fast money investors. If you believe AI compute demand compounds for 5 to 10 years, and Nvidia maintains leadership with Blackwell Ultra, Rubin, and beyond, the bull case holds. If you worry about near-term risks, hyperscaler spending pauses, margin compression, or a cyclical downturn, then caution is warranted. It is a high-stakes game. The potential rewards are immense, but so are the risks. What will you do? Are you buying the dip, believing the growth story has miles to run? Or are you waiting on the sidelines, wary of the risks lurking beneath the surface?